These required minimum distribution deadline traps in 2026 could cost you thousands in penalties. But there are legal fixes that can save your retirement savings. Every retiree turning 73 this year faces a critical decision about their required beginning date that could trigger a devastating tax hit if they get the timing wrong. If you're one of the millions of Americans turning 73 in 2026, congratulations, you've just entered the world of required minimum distributions, or RMDs. But there's something your financial advisor might not have told you. The first RMD comes with a built-in trap that could force you to take 2 distributions in one tax year, potentially pushing you into a higher tax bracket and triggering Medicare premium increases that could cost you thousands. Let's start with the basics. An RMD is the minimum amount the government forces you to withdraw from your traditional IRA, 401k, or other tax-deferred retirement accounts each year. After decades of tax-free growth, Uncle Sam finally wants his cut. The Secure 2.0 Act moved the starting age from 72 to 73 for anyone born between 1951 and 1959, and it'll jump to 75 in 2033 for those born in 1960 or later. The IRS calls this critical deadline your required beginning date, or RBD. Now this is where it gets tricky. If you turn 73 this year, you have 2 options for your first RMD. You can take it before December 31st, 2026, or you can delay it until April 1st, 2027. Sounds generous, right? It's actually a trap disguised as flexibility. When you delay your first RMD until April 1st, 2027, you still have to take your second RMD by December 31st, 2027. That means 2 full RMD payments in one tax year. Let's say your first RMD is $40,000 and your second is $42,000. Instead of spreading $82,000 across 2 tax years, you're cramming it all into 2027. This artificial income surge can bump you into a higher tax bracket and trigger IRMAA surcharges that increase your Medicare Part B and D premiums by hundreds or even thousands of dollars annually. If your income drops after a life-changing event like retirement, you can file Form SSA 44 to appeal your IRMAA determination. The penalty for missing an RMD deadline used to be brutal, exactly 50% excise tax on the amount you failed to withdraw. Secure 2.0 reduced this to exactly 25%, which sounds like good news until you run the numbers. Miss a $100,000 RMD, and you're looking at a $25,000 penalty. That's still enough to devastate a retirement plan. But there's something interesting happening here. The IRS has built-in escape hatches, and most people don't know they exist. The first is the correction window. If you catch your mistake and correct it within 2 years, that 25% penalty drops to just 10%. Using our $100,000 example, that's a $15,000 savings just for acting quickly. The second escape hatch is even better, the reasonable cause waiver. File Form 5329 with a letter explaining why you missed the deadline, and the IRS might waive the entire penalty. What qualifies as reasonable cause? The IRS keeps this deliberately vague, but successful waivers have been granted for illness, death in the family, natural disasters, mail disruptions from moving, and even bad tax advice from professionals. The exact process works like this. First, take the missed RMD as soon as you realize the mistake. Then file Form 5329, but on line 54, write 0 and put RC next to it along with the shortfall amount. On line 55, also enter 0. Don't wait for a response. If the IRS accepts your reasonable cause argument, they'll simply process your return as filed. If they reject it, they'll assess the tax and let you know. You can find all the calculation details in IRS Publication 590B. The IRS doesn't define reasonable error, but patterns emerge from successful waivers. Medical emergencies that prevent you from managing finances qualify. So does receiving incorrect information from your IRA custodian or tax preparer. Even something as simple as not receiving required notices due to a mail forwarding issue has resulted in penalty waivers. For those who inherited IRAs, 2026 marks the end of the grace period. The IRS spent years educating taxpayers about the new 10-year rule, but starting in 2025, they shifted to strict enforcement. Unless you are an eligible designated beneficiary, like a surviving spouse, disabled person, or minor child, the 10-year rule applies. If you inherited an IRA from someone who died after they started taking RMDs, you must take annual distributions in years 1 through 9, plus empty the account completely by year 10. Miss any of these deadlines and you are facing the same penalty structure. The 10-year rule creates its own deadline trap. Many beneficiaries think they can wait until year 10 and withdraw everything at once. That works if the original owner died before starting RMDs. But if they died after their required beginning date, you need those annual distributions. A compressed distribution schedule means potentially massive tax bills in the final years as account balances balloon from continued growth. Now let's talk about the proactive strategies that can help you avoid these traps entirely. The first is the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and charitable giving is part of your plan, you can donate up to $111,000 directly from your IRA to charity in 2026. This counts toward your RMD but does not increase your taxable income. It is tax planning and philanthropy rolled into one elegant solution. There's a crucial detail most people miss: the first dollars out rule. If you take any regular distributions from your IRA before making a QCD in the same year, those distributions count as your RMD first. So if your RMD is $20,000 and you withdraw $10,000 in January for personal use, only $10,000 of a later charitable distribution will qualify as a QCD. Sequence matters. The second strategy is Roth conversions, but these require careful planning. You must satisfy your RMD before doing any Roth conversion in the same year. The conversion cannot count toward your RMD even partially, but conversions reduce your traditional IRA balance, which means smaller RMDs in future years. With individual tax rates potentially rising after 2025 when the Tax Cuts and Jobs Act provisions expire, locking in today's tax rates through conversions could be particularly valuable. For those wanting to defer even more, Qualified Longevity Annuity Contracts, or QLACS, let you set aside up to $200,000 from your IRA or 401k and delay RMDs on that amount until age 85. It is another tool in the RMD management arsenal. For those concerned about bracket management, early withdrawals after age 59 and a half can help. These penalty-free distributions are still taxed as ordinary income, but they reduce account balances over time, shrinking future RMDs. Think of it as tax bracket optimization. You're smoothing out the income spikes that RMDs can create. Automation is your friend here. Set up automatic withdrawals with your IRA custodian to ensure you never miss a December 31st deadline. But remember, if you have IRAs at multiple institutions, you're responsible for calculating the total RMD across all accounts. Bank A doesn't know about your IRAs at banks B and C. Let's address the custodian policies that can either save you or surprise you. Some IRA custodians automatically pay out calculated RMDs before the deadline if you haven't taken them. Others do nothing. Both policies are acceptable under IRS rules, but you need to know which camp your custodian falls into. Don't assume they'll bail you out. The still working exception offers another escape route, but only under specific conditions. If you're still employed by a company where you have a 401k and you don't own more than 5% of the business, which is called the 5% owner exception, and that plan allows it, you can delay required minimum distributions from that specific account until April 1st after you retire. This exception only applies to your current employer's plan, and all other retirement accounts still require required minimum distributions at 73. For 2026, new IRS regulations are taking effect that clarify many gray areas that have confused taxpayers and professionals alike. The most significant change affects inherited IRAs, where the 10-year rule interpretation has been settled. The regulations also update the IRS Uniform Lifetime Table, also called Table 3, or Table 2 if your spouse is 10 or more years younger, and provide clearer guidance on see-through trusts. The Voluntary Correction Program offers another path for those who've made RMD mistakes. Unlike other correction methods, VCP specifically allows you to request waiver of the excise tax for RMD failures. This is particularly valuable for larger mistakes or systematic failures across multiple years. Understanding your exact timeline is crucial. If you turned 73 in 2025, your required beginning date was April 1, 2026, and your second RMD is due by December 31, 2026. If you turned 73 in 2026, your first RMD can wait until April 1, 2027. But remember the double distribution trap we discussed. The penalty calculation is straightforward, but unforgiving. Take the amount you should have withdrawn, subtract what you actually withdrew, and multiply the difference by exactly 25%. On a $50,000 RMD where you withdrew nothing, that's a $12,500 penalty. Quick correction within 2 years cuts that to exactly $5,000. A successful reasonable cause waiver eliminates it entirely. For married couples, coordination becomes essential. Each spouse calculates their own RMD based on their individual account balances and life expectancy using the appropriate IRS table. QCDS can total $222,000 for married couples filing jointly, $111,000 per spouse. But the first dollars out rule applies separately to each spouse's accounts. The bottom line is this: RMD rules in 2026 are both more forgiving and more complex than ever before. The penalties are lower than they used to be, the correction windows are more generous, and the waiver opportunities are significant. But the deadline traps are real, and the stakes are high enough to demand careful planning. Whether you're facing your first required beginning date or you're managing inherited accounts under the new rules, the key is understanding your options before the deadlines hit. The IRS has provided multiple ways to fix mistakes and avoid penalties, but only if you know they exist and act quickly when problems arise. Don't let retirement distribution rules sabotage the wealth you've spent decades building. With proper planning and knowledge of these legal fixes, you can navigate the RMD maze while keeping more of your hard-earned money where it belongs, in your pocket, not the government's.